If you're looking to build wealth and generate passive income, you've come to the right place. Today, we're diving into the top 5 real estate investment strategies for passive income. Whether you're a beginner or already have some real estate experience, these strategies will help you build a portfolio that works for you. Real estate has proven to be one of the most reliable ways to create long-term wealth, and the best part is, with the right strategy, you can earn income with minimal effort. So, if you're ready to explore these opportunities, make sure to hit the subscribe button and stay tuned. Strategy 1. Rental properties. Buy and hold. Let's start with the buy and hold strategy, which involves purchasing rental properties for long-term income generation. This is one of the most common and straightforward real estate investment strategies. The basic idea is to buy a property, rent it out to tenants, and hold on to it for several years while it appreciates in value. So how do you make passive income from this? Well, once you buy a property, you rent it out, and the rental income covers your mortgage, property taxes, insurance, and maintenance costs. Anything left over is your profit, which ideally grows each year as you raise rent and your mortgage balance decreases. Key benefits: consistent cash flow. Every month, as long as your property is rented out, you're receiving rental income. The goal is to have positive cash flow, where your rental income exceeds your expenses. Appreciation over time. Real estate typically appreciates in value, meaning the longer you hold the property, the more it's worth. You're not only earning monthly income, but also benefiting from the increase in property value. Tax advantages. There are numerous tax benefits, such as deducting mortgage interest, property management fees, repairs, and even depreciation. Depreciation allows you to reduce taxable income without actually losing money. Challenges. Property management. Managing tenants, maintenance, and repairs can be time-consuming. However, you can hire a property management company to handle this for you, which typically costs 8 to 12% of the rental income. This makes the investment more passive. Vacancies and turnover. You may experience periods when your property is vacant or when tenants move out, which could reduce your cash flow. Proper tenant screening and investing in areas with high rental demand can help mitigate this risk. Pro tip: when investing in rental properties, location is key. Look for areas with strong job markets, growing populations, and high rental demand. These factors will help you maintain occupancy and ensure steady rental income. Additionally, make sure to account for all costs, including unexpected expenses like major repairs or vacancies. Strategy 2. Real estate investment trusts, REITs. Invest in real estate without owning properties. Next on our list is an incredibly popular and truly passive strategy: real estate investment trusts, or REITs. If you want to invest in real estate but don't want the responsibility of managing physical properties, REITs are a perfect solution. Think of REITs like a mutual fund, but for real estate. A REIT is a company that owns and manages income-generating real estate, such as office buildings, shopping malls, hotels, and even apartment complexes. By purchasing shares of a REIT, you're essentially buying into the income these properties generate without having to actually own or manage the property yourself. Key benefits: truly passive. Once you purchase shares in a REIT, you don't have to deal with tenants, maintenance, or management. The company handles everything. Liquidity. Since REITs are publicly traded, you can buy and sell shares easily on the stock market, just like stocks. This makes REITs much more liquid than traditional real estate investments. High dividends. REITs are required by law to distribute at least 90% of their taxable income to shareholders in the form of dividends, making them a great source of consistent passive income. Challenges. Market volatility. Since REITs are traded on the stock market, they can be subject to market fluctuations, which could impact the value of your investment. Lower control. Unlike direct ownership of property, you have no control over the management of the properties or how the REIT is run. Pro tip: diversify your REIT investments. There are many types of REITs. Some focus on residential properties, others on commercial, healthcare, or even industrial real estate. By investing in multiple types of REITs, you can spread your risk across different sectors of the market. Strategy 3. Short-term rentals, Airbnb and vacation properties. Now let's talk about one of the hottest trends in real estate: short-term rentals. With platforms like Airbnb and VRBO, renting out properties on a nightly or weekly basis has become incredibly popular. If you own property in a vacation hotspot or a high-demand urban area, short-term rentals can generate much higher returns than traditional long-term rentals. Here's how it works. Instead of signing a year-long lease with tenants, you rent your property to travelers and tourists for short stays. The rates are usually much higher on a per-night basis than what you'd get from a long-term tenant, and during peak seasons, the income can be significant. Key benefits: higher income potential. Short-term rentals can generate 2 to 3 times the monthly income of a traditional long-term rental, especially in high-demand areas. Flexibility. You can choose when to rent out the property, and even block out dates if you want to use the property yourself. Pro tip: if you want to make short-term rentals a passive income stream, consider hiring a property management company that specializes in vacation rentals. They can handle everything from guest interactions to maintenance for a fee of around 15 to 20% of the rental income. This makes the process much more hands-off. Strategy 4: real estate crowdfunding, pooling funds for big deals. Moving on to a newer yet rapidly growing trend: real estate crowdfunding. This strategy allows everyday investors to pool their money together to invest in large-scale real estate projects, like commercial properties or apartment complexes, that would normally require millions of dollars to participate in. Crowdfunding platforms like Fundrise or CrowdStreet make it possible for investors to get into these deals with as little as $500 to $1,000. The platform brings together a group of investors who then share in the profits of the project, either through rental income or appreciation when the property is sold. Key benefits: low capital requirement. You can get started with a relatively small investment, giving you access to large, high-quality real estate projects that would otherwise be out of reach. Diversification. You can spread your investments across different properties, locations, and types of real estate, which lowers your risk. Professional management. The projects are managed by experienced real estate developers, so you don't need to worry about day-to-day operations. Challenges: illiquidity. Crowdfunding investments are usually long-term, meaning you won't be able to cash out quickly. You may need to hold the investment for 5 to 10 years to see returns. Platform risk. Not all crowdfunding platforms are the same. It's crucial to choose reputable platforms with a solid track record and transparent fees. Pro tip: before investing in real estate crowdfunding, make sure you carefully vet the platform and the individual projects. Look for platforms that provide detailed information about the investment, including projected returns, risks, and management team background. Also, diversify your investments across multiple projects to spread your risk. Strategy 5: house hacking. Live for free while building wealth. Finally, let's talk about house hacking, one of the best ways to get started in real estate with minimal risk. House hacking involves buying a multi-family property, like a duplex, triplex, or fourplex, living in one unit and renting out the others. The rent from your tenants helps cover your mortgage, and in some cases you can live for free while building equity in the property. This strategy is ideal for first-time investors because you can use an owner-occupied loan to purchase the property, which usually comes with a lower down payment and interest rate compared to an investment loan. Over time, as your tenants pay down the mortgage, you're building wealth with little out-of-pocket costs. Key benefits: minimal living expenses. Your tenant's rent covers your mortgage, allowing you to live for free or significantly reduce your housing costs. Build equity. While you're living in the property, you're also building equity and benefiting from appreciation. Learn property management. House hacking is a great way to learn how to manage tenants and properties, which can help you scale up to more properties in the future. Challenges: being a landlord, you'll be responsible for managing tenants and handling repairs, which can be time-consuming. Tenant turnover. Frequent tenant turnover could lead to vacancies and impact your cash flow. Pro tip: when house hacking, look for properties in areas with strong rental demand. Ideally, the rental income should cover your entire mortgage or close to it, making your living expenses as low as possible. Once you've built enough equity or your financial situation improves, you can move out, rent out your unit, and repeat the process with a new property.